All right, let's get right into it. On September 9th, the water infrastructure supplier Core & Main dropped its quarterly earnings report. And what happened next was an absolute bloodbath for the stock. We're going to break down exactly what went wrong, why it happened, and what you should be looking for next. And when I say bloodbath, I am not kidding. In just one single day of trading, right after their earnings call, the stock plunged over 25%. Think about that. A quarter of the company's value just gone. A drop that big, that fast, it just screams one massive question. Because if you just glanced at the numbers, the quarter didn't look like a total train wreck. I mean, revenue was up, margins were getting better, so why on earth did the market deliver such a brutal verdict? That's the puzzle we're going to solve, because the real story is buried in the details. So to figure this out, we have to start with the earnings report card itself. And what you're about to see is a really mixed message. I mean, it's a classic tale of two different stories that gave both the bulls and the bears plenty of ammo. Okay, right off the bat, you see the contradiction. Look at the top line. Revenue missed what analysts were expecting. But then you look down at adjusted earnings per share, that's the profit number that smooths out some one-time items, and it was a solid beat, 87 cents when the street was looking for 78. So less money came in the door, but on an adjusted basis, they made more profit. This is our first major clue that things are not as simple as they seem. And if you just ignore the Wall Street guessing game for a second, the business itself actually looked pretty healthy. Revenue was up almost 7% compared to last year, gross margins expanded, net income grew by double digits, and their main businesses, the municipal and non-residential stuff, were holding up just fine. So, if the quarter itself was this decent, then the problem wasn't about the past. It was all about the future. And this is where the whole story completely flips. You have to remember, Wall Street doesn't really care about what a company did yesterday. It's a machine that trades on what a company is going to do tomorrow. That massive 25% drop wasn't a reaction to the Q2 numbers. No, it was a reaction to what management said about the rest of the year. And here it is, the smoking gun, the guidance cut. Management took a knife to their full-year sales forecast and their adjusted EBITDA forecast. But the real gut punch, the thing that sent investors running for the exits, was the change in their residential outlook. They went from thinking things would be flat for the year to now calling for a decline in the low double digits. That's not a small adjustment. That is a massive U-turn reversal. And it told us two things were going very wrong. Problem number one, coming straight from the CEO's mouth, was that the housing market suddenly hit a wall. All the talk about higher interest rates and homes being too expensive, well, it finally put the brakes on demand for new lots, especially down in the Sun Belt. Core & Main is at the very front of that whole process. They sell the pipes and parts that go into the ground before a single foundation is poured. So they see the slowdown first, and what they were seeing was not good. And here's problem number two. At the exact same time that demand was slowing down, their own costs were shooting up. Things like employee benefits and inflation on their trucks and buildings were getting more expensive, and that was eating into their profits. So you've got slower growth on one side and higher costs on the other. That is a toxic combination for any company. Okay, so the outlook is bad. The stock is in a nosedive. What's the game plan? Well, management didn't just throw their hands up. They laid out a pretty clear strategy for how they plan to fight back against these headwinds and reassure everyone that they've still got the situation under control. First, they tried to put the problem into perspective. Yeah, the residential business is weak, and that's a real drag. But look here, it only makes up about 20% of their total sales. The other 80%, which is tied to much more stable municipal and non-residential projects, is still holding up. That acts as a really important cushion. So, with that in mind, here's their four-part counteroffensive. Step 1, attack those rising costs head-on with what they're calling targeted cost-out actions. Step 2, keep playing offense by buying other companies, like their recent deal for Canada Waterworks. Step 3, double down on what's working, which is that stable municipal business. And step 4, keep planting seeds for the future by opening new branches in key markets. So if you're watching this stock, here's your roadmap for what to look for. Over the next 3 months, you want to hear how that Canada acquisition is going. The next earnings call is going to be absolutely critical. We need to see if their cost cuts are actually working. And over the next 6 months, the real tell is going to be the pace of new city and town project awards. All right, so we've broken down the what and the why. Now for the big question, what happens next? In this final segment, The Next Call, we're going to give you our analyst's take on where this stock might be headed. Given everything we've just talked about, we are officially assigning a rating of market perform to the stock. It's a neutral stance, and really, it reflects a company that's caught in a massive tug of war between some serious short-term pain and some pretty solid long-term strengths. So let's be crystal clear about what market perform means. We don't see a compelling reason to be super bullish or super bearish right now. The slowdown in housing is just too big a problem to call this an outperform. But at the same time, that big, stable 80% of their business provides enough of a safety net to keep us from calling it an underperform either. Basically, it's stuck in neutral. Now, with all that said, for those of you who are a bit more aggressive, every big stock collapse creates a potential opportunity. So let's talk about a wild but plausible trade idea as we look ahead to the next quarter. We're calling this the low bar relief rally trade. The thesis is pretty simple, that 25% drop was a classic market overreaction. Management just threw the kitchen sink into this guidance cut, which means they've set the performance bar incredibly low for the next report. The catalyst would be literally any good news. Cost cuts working a little better than expected, or maybe the housing market just stops getting worse. If that happens, this stock could pop. The action then would be to think about a tactical long position heading into that Q3 report, making a bet that they can step over this new, very low bar. And that really brings us to the ultimate question for anyone looking at Core & Main right now. After this absolutely brutal 25% haircut, is all the bad news finally baked into the price? Or is this violent drop just the first sign of a much deeper problem? The next quarter's results are going to tell us a lot.
And as always, a reminder, this is not financial advice. Our analysis is for informational purposes only.